Hello and welcome, What the Finances, to another episode of the What the Finance podcast, where we talk to experts to help gain a greater understanding about what is happening in the world of finance, investing, and markets. So, on today's podcast, I'm happy to welcome Stephen Van Meter, who's an educator and influence in the macro investing world with more than 20 years of experience in the financial services industry, includes the design and management of macro strategies. So, Stephen, thanks for joining the podcast today.
Anthony, it's a real pleasure, and thank you for inviting me on your show.
You're welcome, and I'll put it. I'll say it straight away. You have a really good YouTube channel, which I really enjoy, and I don't know how you do it, but you upload videos every day about really important things. So everyone should check that out. But anyway, I'll go straight into the question. So it seems almost every week we're getting this new, like something's collapsing or something's, there's a new crisis happening. This week was the pound. It's been the yen. We've seen the housing market, stock markets, commodities. I guess so. In your opinion, is it really this bad, or what do you think's happening?
Yeah, actually, I do think it is this bad. And if we look at kind of what the catalyst is, it's the dollar. I mean, here we are in a global reserve currency. The dollar is the gold standard of the system. And, the best way to kind of explain it is we think about Goldilocks and the Three Bears, a story. And, they're getting ready to eat the porridge. There's one that's too hot. There's one that's too cold and one that's just right. And that's the same thing you want with a dollar. You don't want it to be too high. You don't want it to be too low, but you kind of want it to be about just right. And it can fluctuate around a little bit. But when it gets too hot, and it's really getting too hot now, it really causes problems in the global financial system. And so that kind of leads us to the question then of, well, why? Why is the dollar going up? Is it because the Fed's tightening? Is it because other central banks aren't tightening fast enough? And the real truth of this, Anthony, and this is really what's kind of the problem, what we're seeing across a lot of other asset classes is we have a global dollar shortage. And I know you had my friend Jeff Snyder on and talked about that recently, but that's really what the story is there's a shortage of dollars in the system. And what you're seeing is everything reacting to that.
And I guess we could go, as you said, we mentioned a bit with Jeff, but why do you think there's a shortage? I guess, there's QT happening, there's all these other factors, but what's your hypothesis on why that's happening, why this is happening?
Well, the problem we have with dollars is how they're created. So we have to always go back and you think, how are new dollars born? And a lot of people don't know. They think, okay, a central bank is printing them. In this case, it would be the Fed. And the Fed actually has no authority to print money. I mean, they can print some physical cash to meet the needs of the banking system. But in terms of printing new dollars or digital dollars, despite what Fed Chair Powell said on 60 Minutes a couple of years ago, they have no power to do that. Quantitative easing is not money printing. So the question then is, again, where does money come from? And it is born when people borrow. So out of the commercial banking system, out of what Jeff will say, the Eurodollar system, which is a foreign bank outside, just any bank outside the US that issues a dollar denominated loan. That's how dollars are created. And the problem is we're not creating enough of them. And then when we kind of look back to what quantitative easing did in the pandemic, in the kind of really will cement this is to save the U.S. economy. What did the U.S. government do? They borrowed a bunch of money, which when we borrow here in the U.S. is predominantly from foreign sources. Now, sure, there's people, domestic, mute funds and pension funds and individuals that purchase it. But by and large, more than half of all borrowed money comes from outside the U.S. And then what did we immediately do, or what did the Fed then do? Is they did something called quantitative easing. And when you understand what that does is it takes a bank deposit and it forces the bank to use that deposit to buy a treasury security or a mortgage-backed security. So what you have is a government spent all this money out into the real economy. People got the money. They went down to their bank. Well, I mean, it was electronic, but it was deposited in their account. And then the Fed comes along to the bank and says, hey, you need to take that deposit and buy a treasury security because we're going to turn around and buy that treasury security from you. So the issue is, why is there a dollar shortage? Is because effectively the United States government sucked all this money out from the other part of the world to put it into the commercial banking system. The Fed put it on lockdown and it didn't get cycled back to the rest of the world. And that's where we see dollar shortages, because here in the US, I don't see a dollar shortage, right? I can open up my bank account and say, well, there's dollars in there. But outside to the other part of the world, well, there is a dollar shortage. There's a lot of dollar denominated debt. that gets built up because, again, the dollar is a reserve currency. And what do they need to pay on those dollar denominated loans? They need dollars. What do we need to run, global commerce? We need dollars. What do we need to buy commodities to produce things? Dollars. There just isn't enough of them.
So are you seeing a potential dollar squeeze occurring, or like it could happen in the future, or have you already seen that?
Well, we're seeing it now. I mean, that's why the dollar. Yeah, I don't know where the DXY is today, but somewhere north of 112, and looking like it's going higher. And that's all it's indicating is, we just don't have enough of these things, and that's why you see this panic in the Treasury market. A lot of it is due to the Fed raising rates. They're concerned for inflation. The other side is, when you look outside the rest of the world, and people hold their dollar savings in Treasury securities because they're very liquid. Now, in a dollar denominated system, you don't want to be selling your Treasury securities. That's like your savings account. And a lot of people kind of may be struggling with that, but think of it, it's easier to think if we were on a gold-based system and you had gold, do you want to give it up? Well, no, of course not. In fact, if you're giving up your gold, that means something's not going right. Same thing with your savings account. You lose your job, you have some savings, and you use it, but when it gets down to a certain level, whoa, panic sets in. Well, this is the same thing in the global system. Is they need dollars, they start selling the Treasury securities, but that becomes the alarm of like, wait a minute, this isn't how the system should work. In fact, it's an indication that demand is falling off, because if the global economy is humming along and doing what it's supposed to do, new dollars are constantly being born and created, and that means the global economy is expanding. When we see a dollar shortage, particularly in this case outside the US, we see foreign central banks starting to sell Treasury securities. It's a strong indication of a contracting global economy and deflationary money.
Yeah, and I guess if you're a asset owner, or if you need dollars, you'd probably sell the most risky assets first, and then if you're really desperate, then you'd sell those bonds. So is that what you're thinking is happening? Like, we've seen the markets go down, and now people are having to sell their bonds. It's almost like the last resort.
Well, what we see is foreign central banks. They're the ones that are holding these, Treasury reserves. They start selling, bonds, and then there's a certain point that says, "Hey, wait a minute, we don't want to sell any more of these." And then other people, may say citizens and businesses and foreign outside the U.S., they need dollars, and they've been maybe selling some Treasury securities, and then they go, "Wait a minute, this is not what we want to do," and they start selling stocks. And so, what we've actually seen is foreign investors have been big buyers of treasuries, but not enough to offset this, just upward pressure on yields and the demand for dollars right now. Now, at some point that will change. Maybe we'll see, China devalue their currency. Maybe we'll see other countries try to, devalue and adjust the peg. Something is either going to break, or somebody's going to come in and do a deval, which is kind of the move of last resort. But something's going to happen, and you kind of almost sense that something's about to break.
Yeah, especially when you see, commodity prices quite high, especially energy. So not only is dollar going up, energy prices going up. So it's like that double whammy that we've experienced.
Yeah, but we're also seeing energy prices start to come down. And of course, we know crude oil price is priced in dollars, but that's also an issue of demand. So if we see energy prices coming down, that's actually telling us the global economy is slowing down. Now, from an inflation standpoint, if you're a central banker, if you're Jerome Powell, you're like, all right, yeah, okay, good news. Oil prices are coming down. Then that means gas prices are coming down. That means inflation is going to come down. But it also means that we're going to see more unemployment claims. It's kind of interesting that when you look at a chart of the dollar, or not the dollar, but of unemployment claims and oil, what you see late cycles, you see oil, if it's rallying really high, the economy starts to reject and say, hey, you know what? We can't afford these higher energy costs. And next thing you know, you start to see some layoffs. And then oil prices start coming down as you get closer and then into the recession. And then so you know, all of a sudden unemployment claims are rising. And people say, well, that doesn't make sense. If energy prices are coming down, why would that happen? Well, you got to understand, in high periods of high inflation, everybody's demanding wage increases. You have rent increases, you have insurance increases, everything's prices going up. Well, if you're an energy company, you need prices to stay high and keep going. If they start going down, well, you start losing money. Next thing you know, you're laying off. And of course, energy companies are just massive employers, not just directly, but just indirectly into the economy. And next thing you know, this all flows downhill. So really, when we start to see energy prices come down at this point, we can cheer that inflation is coming down, but it's not a good sign for the economy.
So you think we're going to see a recession quite soon, or we might even already be in one?
It's a good chance that, Anthony, that we are already in the early phases of recession. That would be pretty consistent. What we're not seeing yet, which may be kind of the last shoe to drop, is unemployment claims to rise. I suspect over the next couple of months, we'll start to see that, particularly with the stock market being down. A lot of Americans base their financial decisions on how wealthy they are. So when the market's up, they will spend more because they perceive the market's going to go higher. So they'll spend, spend, spend. When it comes down, immediately it doesn't change, but there's all of a sudden, hey, the market's not going back up, or it's going to keep going down. Well, next thing you know, their spending habits completely change, and then you start to see disinflation, recession prop up, and that's even a bigger challenge because right now we've got just massive amounts of inventory sitting here in the U.S. Some of my inside contacts, they're telling me, warehouses are stuffed full. We're hearing from retailers, shelves are full, and the worst part isn't that we just have the inventory here, is they ordered so much more, it's on the way, and they don't know where to put it. They have nowhere to go with it. And then we're already hearing, rumors from these wholesalers and retailers who don't want to comment about it, that foot traffic's down, sales are down. And that's a big problem because this is a time of year when people are getting ready to go into holiday spending and they need all this inventory to clear it. And if they don't, it's going to be huge discounts in an attempt to get rid of it. Again, more signs of deflation.
Yeah, I guess especially in the UK and Europe when electricity prices are going up as well. So there's, as you said, people have less of that discretionary money that they can use on many of the items.
Yeah, I honestly don't know how if Europe gets out of just a recession, I mean, my hat goes off to them. If more likely, I mean, I'll be surprised if they don't go into recession. And I don't mean to say that negatively. I'm just saying energy shocks like this are just horrendous on economies. I mean, next thing households, they can't afford to pay bills, businesses shut down, more unemployment. And then if you can't get the energy you need, even if you're willing to pay the price, I mean, it just spirals out of control. It's just not a good situation what's going on there, and the idea that if Europe were to enter a very nasty recession, that the rest of the world is going to be immune, yeah, good luck with that. There's plenty of demand in terms of European consumers that drive the global economy. Their manufacturing base supplies things to the global economy. We need them, they need us, and if they go down, well, they may be first, but everyone will follow.
So it sounds concerning. So if a lot of these retailers and if a lot of these businesses were to go down, you think that would have quite a big impact on sort of banks and the stability of banks. Do you see there being a potential, I guess, what we saw in 2008, or do you think they're quite stable at the moment? What's your opinion on that?
Yeah, and that's exactly kind of what happened in 2008 and 9. This happens in late expansions. There's just massive amounts of debt. You see, central bankers get all, worked up about inflation because they maintain these loose money policies for so long, and they were afraid to raise rates, and they finally start getting, like, okay, we're going to do it. And next thing you know, the economy starts to slow down, and you have all of this debt built up, and you don't have enough economic output to service that debt. And so, yeah, I see the same thing. I mean, you would think that perhaps the pandemic and all of this, free money that was dumped on taxpayers around the world, you could have been used for something good, perhaps paying down debt. And at first they did. And then they're like, hey, this money's not going to stop. And so they borrowed like crazy. And now, of course, what we're finding out is this wasn't the beginning of some new bull market. It wasn't the beginning of a new expansion. Perhaps it was just the pandemic was just a blip in the midst of the fact that before the pandemic, the global economy was headed into recession. We conveniently had the pandemic, which stalled it off. But due to all this policy and now overly aggressive central bankers, tightening policy, we're headed right back down that path, maybe even faster. So yeah, I don't think the banks get out of this unscathed at all because, obviously they've lent money, and the longer these expansions go, what they will do is, they'll go from their top tier clients, that just don't need money. Hey, I'm already rich enough. I've already borrowed a bunch. I've bought a bunch of assets. Hey, I'm doing okay. And I don't want any more money. Even though the banks say, yeah, well, will you please borrow? Because we know you can pay it back. So the banks start going down, their credit tiers. And next thing you know, they're doing a lot of subprime loans that we don't see. And then next thing you know, those are the first to go into an all-out crisis at a time where you start thinking about, can the Fed react here? Well, they've been pretty clear. As long as inflation stays up, we're not. I mean, something interesting is going to happen, and I don't mean interesting in a good way.
Yeah, it's concerning to think that the Fed are so hawkish on what they're going to do. And as you said, there's so many indicators saying that we're going into this recession, and inflation is oftentimes quite a lagging indicator. So unfortunately, it seems like we'll experience a lot of pain before we actually get inflation to go down, I think.
Well, yeah, inflation is absolutely a lagging indicator. It's one of the most lagging indicators the government produces, and it's not intentionally. It's just very difficult to measure, and it gets measured with a lag. So I like to say the Fed is doing monetary policy by looking through the rearview mirror. They've got black tape all over all the windows, and they're trying to drive the car forward, looking backwards. But that's what they have. I mean, we don't know the future. We just don't know enough, and it's not enough real-time data to help the Fed make policy. I mean, we know we have data, but it just isn't enough. And so the reason we, of course, see the high probabilities that periods of high inflation lead to recessions is really simple. Is you get to the point where the wages and everything else is not sustainably growing fast enough for consumers to afford those higher prices. They start to reject them. The Feds are then still tightening, this for various central bankers because they're focused on their look back. And then next thing you know, the economy starts to slow down, inflation comes down, and the Fed finds themselves, behind the curve. But by then it's too late because all of a sudden, the layoffs are hitting, and then consumers are now saddled with, lots of debt and no prospect of paying it back. That flows back down to the banking system. You get a credit crisis, financial crisis, central bankers slash rates. I mean, it's the same thing because it's how it always seems to go.
Yeah, it always repeats itself. So if we link back to the dollar, if that were the case, because I look at the US and it's hard to believe, but it's almost in a better position than I guess the UK, Europe, China, many other countries. Do you think we'll see the dollar continue to rise and almost spiral up to strength, or what's your opinion on that matter?
Yeah, I think the dollar absolutely goes higher. And one of the challenges is because we come back to how's new money created? It's through lending. Well, if you think about it, will people borrow at higher interest rates? Well, sure they will. But will you get more? Where do you get more money created? At higher rates or lower rates? The answer is at lower rates. That's why for the last 40 years, we keep seeing central bankers and policymakers, driving rates lower to create credit. Here in the US, mortgage rates, I think today are now over 7% on a 30-year. I could be wrong, but that's very, very high. Now, will there be people that are going out today and signing paperwork and buying a home and getting a mortgage out that rate? Yes. Will there be a substantial number of them? The answer is no. And that's the problem is we need lower rates to create new money. And of course, that's the problem is that's why higher rates stall out the economy. And that's what the Fed wants to do. That's their intention is they're trying to pull back on this aggregate demand curve. They're trying to slow the economy down. The problem at the same time is they're slowing down money creation at a time when the global financial system is screaming, hey, we're already short dollars. What are you doing here? You're killing us. And that leads to deflationary crashes. That's why, Jeff Snyder, no doubt, when he was on your show, talked about the inverted yield curve, the inverted Eurodollars futures curve, the fact that the front end, the 4-week bill rate is inverted against the Fed's overnight reverse repo rate. You see all of these inversions, and all the bond market is saying is, look, yeah, rates may be going higher, but what we're telling you is the Fed's making a huge mistake. Either the Fed capitulates or something breaks. That's what these curves are telling you. There's more pain in the future. That is what's scary. And so, yeah, I think the dollar does go absolutely higher. There's nothing at this point short of China or someone else coming out and devaluing against it to stop that move.
Yeah, I was talking to some people at work and they're like, yeah, we're definitely not going to the US anytime soon. We wouldn't be able to get over, wouldn't even be able to stay in a hotel just because the pound's been absolutely destroyed. So I guess if we look at the markets, or I guess the economy in general, where do you see the weakest link? Because I guess that's probably where we'll see the catalyst and whether there'll be a crash. Is there anywhere in particular that you're watching?
Yeah, I'm really kind of focused on, I mean, of course, we see the bond market selling off, very unprecedented move there. We see a huge disconnect between the fundamentals of the economy and the bond market. What we see is the bond market really reacting to, central bankers. The bond market, I mean, just like, hey, we're going to keep pushing rates higher, and the bond market just, go like, oh my God. And so it's struggling because fundamentally what we should see is yields falling here. In fact, if we go back and look at the data over the last several decades, when we see slowdowns in the economy, and we can look at the manufacturing sectors, we can look at the Fed surveys, the regional surveys, we can look at the ISM, we can look at the S&P Global, which used to be the market purchasing managers indices. We look at all that data, and what do we know is right now, historically, Fed should be paused. At the least, they should be like, hey, you know what? We may be pushing this too hard. We're going to take a breather here. In many cases, they're starting to cut a little bit. Right now, they've got both feet slammed on the brake pedal here for the economy. When we go back far enough, there's not a lot of cases they've done this. It was like they learned their lesson in the late 70s, early 80s, because they drove a double dip recession by continuing to tighten policy, and they had a massive recession and then followed by another massive recession before they ultimately capitulated and drove rates down. So I'm really concerned about the bond market, but I think at some point it starts to change its tune. When it does, though, that's not bullish for equities. I mean, we haven't even seen a lot of selling in equities. A lot of people think we're at the bottom of a bear market. The reality is we're more likely in the beginning of a bear market. We don't see bottoms until the Fed's almost done cutting or have gone all the way where the market says they're done. And we don't see the market bottom until the yield curve is done steepening or very steep. It's not even started. Rates haven't even started going down. So, you start to look at the picture and you say, yeah, interest rates are causing a huge problem in the not only U.S. economy, all around the world. And stocks are usually the last to fall, and they're looking like that they're not going to hold up too much longer.
So do you think, as you said, a lot of central banks, especially international central banks, are selling their bonds? Do you think maybe the international landscape might stabilize a bit and then the US would potentially fall? Or do you think it'll be like dominoes, one after the other?
At this point, I think more likely to see a domino effect. Nope, nobody seems to be doing anything about the dollar shortage. I mean, there's a lot of denial because of inflation. I mean, the problem, inflation is a big problem politically. Consumers hate it to begin with. I mean, we tolerate, okay, yes, we know prices are going to go up, and as long as my wage goes up, but when it goes up too fast, and you're hearing policymakers, drop this word transitory, and you're going like, it's not transitory in my household. Well, after a while, what happens is consumers get really tired of this. They go to the ballot. They don't care who, doesn't matter whatever political party's in power, doesn't matter what party they are. It usually means the establishment party is gone. They're willing to take anybody else because the people in power are not making their life better, making it worse. That's the challenge here. Here in the U.S., we have the midterms coming up. We have high inflation. People are just, we're seeing data all the time that says the average household, and I know it's true in the UK, it's true in Europe, it's true all around the world. The average person around the world is broker now than they were before and has more debt. It doesn't work out too well. It doesn't lead to economic expansion. Ultimately, people will be forced to sell stocks to make ends meet. They'll be afraid to stay in the market because the central bankers are telling us, what do we hear from the Fed? Effectively, we want to see stocks go down. We're doing the reverse of the wealth effect, and we're going to keep going until inflation comes down. People need to heed the warnings. The days of the Fed put on the market, those right now are gone. Maybe they'll be back, but not until we see inflation come down.
So do you think, as you said there, potentially it's not looking like a bottom? Traditionally, what would happen is once they've fully cut interest rates, that's when we normally see the bottom. So do you think that's what maybe people should be waiting for, or what's your opinion on the matter?
Yeah, I mean, that's something if someone was looking to deploy capital, I mean, and they were specifically looking to buy stocks, that's kind of, either you're going to dollar cost average in because you disagree with me, which is fine. There's no problem with that at all. And if you dollar cost average in, great, then you'll be okay. Sure, some of your money is going to go down, but hopefully you'll dollar cost average through whenever the bottom occurs, and you'll come out ahead long term. And that's fantastic. But if you're looking to deploy a lot of capital, you either need to do some form of hedging, risk control, or at least to have the idea that what you're doing has some hedging or risk control. Because historically, when you start to see the Fed change their tune, it's usually not a good sign. And in this case, we're already seeing, again, these survey data telling us that, the economy isn't that strong. The manufacturing base, the services sector is not that great. Now, the official government data say, hey, everything's okay. It happens with a lag, so hang tight. Next month or two, we'll likely see that turn down. And then all of a sudden, what we're going to find out is the bond market is going to say, hey, Fed, you're wrong. We're calling your bluff. Yields come crashing down. Something breaks. And next thing you know, the Fed is in full reversal along with all the other global central bankers.
Yeah, it's fascinating how it works. I guess the challenge is they want to try and show that they have, what they say happened. Kept talking about transitory, didn't happen. And now if they keep talking about tightening and it doesn't happen, there's going to be pandemonium, I think.
Well, I also think, Anthony, there's a lot of political pressure too. I mean, Congress created the Fed, they can end the Fed too. So, everybody's pointing the fingers as, hey, Fed, you created this inflation, which in a sense is, I'm sure they have blame there, but they weren't the ones that borrowed a lot of money and doled it out, like candy on Halloween. They didn't do that. So you start thinking about, okay, well, is the Fed responsible? Well, we can look back and say, well, lower interest rates and quantitative easing really haven't created inflation, but right now they're getting the blame. And, are there people in Congress that would love to end the Fed and take over their powers? Yeah, absolutely. So, what do you do if you're a central banker right now and you're maybe concerned about your independence or losing your job? A lot of them are, they're not hired into the position, they're appointed. And so they can, get removed. Well, what do you do if everyone's saying, hey, it's your fault for creating inflation, we want you to bring it down? All right, you're not gonna like it, I'll bring it down. You're gonna be crying, but don't worry. It's happening, and that's what we see here. I don't know if this is the most aggressive Fed hiking cycle in history or darn near close to it, and we're doing it into a weakening global economy. And not only that, we're seeing all the others, for the most part, not all of them, but most of the central bankers doing it. What really concerns me, Anthony, isn't that we're tightening monetary policy, is that during the pandemic, we all kind of reset country-wise down at the bottom. So it's like starting back at the starting line of a race, because when you have an expansion, what you want is, hey, if one country enters a recession, you want the rest of the world in an expansion so they can recover. But we all reset to the beginning, and we all kind of took off almost at the same pace. Some opened up a little bit faster than the others, but we all started the race relatively synced. Now we're sinking. Now the tide is turning. Who's going to bail us out? Policymakers right now around the world are going to be afraid to go helicopter drop money because people don't want inflation. So they might get voted out. Central bankers are afraid to do anything because they might lose their job or get the blame, or, the situation isn't good. That's my concern, is we're all headed down together. No one's going to bail us out.
It's very concerning. So what I've been hearing a lot as well at the moment is, maybe not in the short term, I guess in longer term, people are talking about deglobalization, demographics, I guess onshoring, all these trends that they say could actually lead to longer term, like higher inflation. Maybe not what we're saying now, but maybe 4 or 5% on a consistent basis. So do you see maybe deflation happening in the short term and then that happening long term? Or I know Jeff really thinks, it's all about monetary policy. I don't know if you have an opinion on that.
Well, yeah, I think the stock market has a big factor here. I mean, you look at the baby boom generation, not here just in the U.S., but around the world. And while this is not true in every country, because some countries are just very poor, that generation worldwide is most money of all. So the idea was these boomers were going to retire. They had all this wealth. The market was going to keep driving higher, and they were going to spend it. And they, boy, you talk to them, but they had no problem. I mean, we got vacations and cruises and golf and parties. I mean, there's no end to what they wanted to do. And you know what? Hey, that's a great position to be in. Cut their wealth in half. They're not going to spend. I mean, you got to remember, these are children of Depression era. That's what, their parents were Depression era. They know what it's like to be poor. They know what it's like to be rich, but they don't want to be poor again. You cut their net worth down, their spending is going to go completely into the reverse, and they're not going to be able to come back and spend out of fear, because they too have debt. They have big homes, they have RVs, they have, pretty opulent lifestyles. For a lot of them, you're going to see their spending cut. That's the question is, is if we see a big rebound in the market, we could see that spending come back. You see the markets go down, maybe stay down, all of them run to cash or treasuries where they're earning a lower yield. Their spending is going to grind to a halt. We won't see that demand come back. In fact, we may end up seeing a lot of them go back to work.
That'd be like 2008 round two, wouldn't it? Because I think that's what happened. A lot of them, they didn't leave the workforce, and now they've retired. But yeah, could happen again.
Yeah, how do you fix a labor shortage? Just have a recession. Guaranteed that usually works. Drive the market down 30, 50%, and people will go back to work.
Get people working from home so they don't have to move. They can work till they're a bit older. Yeah, it's fascinating. So I guess as someone who's had sort of 20 years in the industry, is there any, maybe not advice, but any lessons you've learned that you think will sort of put you in a good position for today and that you think other people should know about?
I would tell people to study the cycles, what typically works. Right now, we're not seeing the bond market do what it normally does. A lot of people are saying, okay, well, that era is dead. Interest rates are only going to go up. Here's the deal. The global monetary system has not changed. Again, we're seeing a decoupling. But take a look at the bond market in past cycles. Look at the stock market in past cycles. Come on, whatever it is you're trading and investing in, whether you're buying homes, whatever your world is, your business is. There's a reason why you see a lot of businesses, a lot of households fail during recessions. They have no cash reserve. They have a lot of debt. The people and particularly the businesses, and if you're a small business owner, even better, those who survive the recession, and even better, can advertise through it. Their businesses boom coming out of it. Why? Because they were survivors. They were smart, and people look to them and say, "Hey, I don't know how that person made it through. I don't know how their business made it through. Boy, I'm gonna support them because I want to do business with someone that's not going to have problems down the road." So think about paying down debt, raising up cash. You don't have to chase the markets. Wait for opportunity. See what you can do to sustain. Make sure your household's in good shape, your business is in good shape, because you want to come out a winner on this. You don't want to go down with the ship.
Yeah, I think that's a vital message. So, Stephen, thank you so much for your time. I really appreciate it. I guess my last question, is that the message you want to leave people with, or is there another message about maybe, what to expect or?
Yeah, I think the issue with bear markets and recessions is very few people get out unscathed. Many people that think they can find out, they think their job is secure. Turns out maybe it's not. I mean, you don't know. And so the reality is, if maybe you've got your side hustle, maybe you've got a little extra debt, shore up your finances, because maybe you are immune. Maybe you're one of the lucky few that you go right through the middle of the hurricane and just barreling down on where I'm at right now, and you don't even notice it. It's just a dry patch for you. That's awesome if that's your position. A lot of people, they're going to get whipped around and wet. And you don't want that. So put yourself in a position to come out ahead. Remember, you think about recessions are an opportunity to get ahead. If you can think about it that way, you don't always have to make money in every environment. You don't have to always do it. Sometimes you need to be strategic and plan ahead. Unless you're 90 years old, then not much you need to worry about. But if you're young, you'll have recessions in your life, and what you need to do is leverage them. There'll be cheap assets. There'll be opportunities. If you can take advantage of them, you'll come out a winner.
I think that's a great message. So, Stephen, thank you so much for your time. We mentioned your YouTube channel. Is there anywhere else people could maybe find your work and what you do?
Yeah, they can also check out a research project I'm working on with Jeff Snyder and Tracy Schucharge. He's an energy and materials expert. They can check it out at Markets Insider Pro. I'm not sure when this is airing, but it may be free for just a few days. And if not, we can always get a coupon code. One of us can come back on. We'll get a coupon code for your audience to check it out. There is a 30-day trial. So if anyone wants to jump on that maybe missed the free part and see if they like it, they're welcome to do that. But yeah, have one of us back on, and we'll do a promotion for all your audience. How about that, Anthony?
Oh, sounds great. Yeah, you have to come back now. You don't have a choice. But perfect. It should go up tomorrow, so they should. So everyone, if you're watching this, go try it out. Yeah, I've been reading a few of the articles and I've really enjoyed it. So, Stephen, thank you so much for your time.
Anthony, it was a pleasure. We'll see you soon.
Thank you so much for listening. And if you enjoyed the episode, please subscribe and click the bell icon so you are notified when new podcasts are released. I hope you're leaving with some great value about investing, trading, and finance. See you on the next show.